Hello, my name is Clive Cochrane and welcome to my YouTube channel, The Cochrane Codex. I do very much hope that you will find this video and many of the videos which I have at my channel to be of interest, and could I then recommend that you subscribe to the channel where you will be notified as to when I add new content. The topic for this video is Asset Liability Management and Maturity Transformation. Now, what this really focuses on is the way that in the banking world, banks, and specifically the Treasury function within a bank, manage potential mismatches between what's on the asset side of their balance sheet versus on the liability side of the balance sheet. Hello, my name is Clive Cochrane and welcome to my YouTube channel, The Cochrane Codex. I do very much hope that you will find this video and many of the videos which I have at my channel to be of interest, and could I then recommend that you subscribe to the channel where you will be notified as to when I add new content. The topic for this video is Asset Liability Management and Maturity Transformation. Now, what this really focuses on is the way that in the banking world, banks, and specifically the Treasury function within a bank, manage potential mismatches between what's on the asset side of their balance sheet versus on the liability side of the balance sheet. What I want to focus on is liquidity risk management, and I'm going to begin by talking about maturity transformation. Now, the fundamental business model for banks is the maturity transformation of short-term deposits into long-term loans. This underlying transformation model makes banks inherently vulnerable to liquidity risk, both at the institution-specific level and also at the systemic level. Most of a bank's commitments create a funding gap, which has then potential stressful implications for the bank's overall liquidity. Liquidity shortfalls at a single institution can have system-wide repercussions. For example, the collapse of Lehman Brothers in 2008, followed by the almost collapse of AIG, this huge insurance firm, which was ultimately bailed out by the US authorities. Both of those were examples of a major systemic liquidity crisis. Financial market developments in recent times have increased the complexity of managing liquidity risk. Let's have a look at a simplified, and I do emphasize simplified, bank balance sheet. So over on the left, we have the assets, sometimes called the use of the funds available to the bank. And let's suppose we now have loans given to individuals and small, medium-sized businesses. There could also be loans to large corporates as well. We have mortgages. Now, mortgages, not necessarily found on every bank, are illiquid by nature. They are very long-term, and the bank basically considers them to be illiquid assets, which is one of the reasons why many banks would rather have those mortgages securitized and essentially removed from their balance sheet. Another major category for the assets would be very liquid assets. For example, the bank might be holding short-term government bonds, even long-term government bonds, but that then could then introduce an element of not so much illiquidity, but duration risk. Over on the right side, we have liabilities and capital, which is in some ways what the source of the funding is for these assets over here. And here we can find retail deposits from individuals, from corporates, and also, of course, the bank can go into the money markets and obtain funding from, say, the repo market and various other sources. And down at the bottom, we have the capital of the bank, sometimes described as own funds. And this essentially is the bank's, this is the difference essentially between what's over here and the amounts down to there. Maturity terms of assets and liabilities invariably will not be matched, which thereby creates a liquidity gap. Effective liquidity management is the ability of a bank's treasury function to fund new assets, roll over liabilities, and meet obligations as they become due without incurring unacceptable losses. Liquidity risk can then arise in two main forms: macro factors, system-wide liquidity problems. That was well exemplified back in the 2008 period. We touched on Lehman Brothers and AIG, and I think it's fair to say, and that period, especially culminating in the latter part of 08, was very much a systemic liquidity crisis. I even wrote a book on that topic. Micro factors. Now, the individual banks might also suffer from liquidity risk problems, even if there is not an actual systemic liquidity problem. This can arise from creditworthiness being put in doubt, reputational damage, that type of thing. Let's turn now to ALM, Asset Liability Management, which is essentially the function or the role of the Treasury within a bank, or indeed many other organizations. Cash outflows and inflows are by their nature uncertain. They can be affected by macro and system-wide events, as just discussed. Liquidity risk management requires tools that provide probabilistic modeling scenarios and thereby a way of addressing this uncertainty. ALM models, asset liability management models, should hinge on a detailed analysis of the probabilities of outflows and inflows under different broad macro conditions. The components of a bank's funding costs can be illustrated in this little diagram here. So the funding cost can thereby be broken down in terms of this stack here. So we have at the bottom the risk-free rate. Then we have these different layers in this part of the stack: a credit risk premium, that depends on the borrower's credit rating essentially, a macro component, we've touched on that already, and a bank-specific component. We mentioned that too, the idiosyncratic risk associated with, say, the particular bank that is obtaining funding. Now, if we move to the next layer in the stack, we have a liquidity risk premium, which itself has both a macro and a micro or idiosyncratic component. And there are various other miscellaneous costs. So to summarize from the last slide, in terms of the cost of funding, it can be decomposed into a risk-free component, a combination of credit risk and liquidity risk premia, and other costs. And the risk premia that I just mentioned are themselves influenced by macro factors, the broad economic outlook, an increase in the riskiness in the banking sector, for example, and factors that are idiosyncratic to any given bank. The management of funding costs should be harnessed in the bank's funds transfer pricing model, or FTP, and the various methodologies associated with that. That has in fact been covered elsewhere, so I will not go deeply into FTP. One key idea is to distinguish between the marginal funding cost and the average funding cost for a bank. And the marginal funding cost is the more relevant, the more pertinent, because this represents the cost of an additional unit of funding, gives the bank and the Treasury within the bank a much better handle on the specific needs as and when they arise at the margin. The average funding cost is also relevant, but this is the average cost of the existing stock of funds as accumulation of past flows of funding that have yet to mature. And broadly speaking, within the FTP model is to ensure that new funding replaces maturing funding in similar amounts to support a relatively stable pool of assets. Let's just briefly talk about one obvious source of liquidity risk to a bank, which is a runoff of deposits. Now, prima facie, it is entirely rational for depositors to get into a queue or lineup if a bank run starts, even if the rumors of the bank's problems are groundless. Now, I've mentioned the idea of standing in a lineup or queue. That's the sort of more typical image of a classical bank run. Nowadays, of course, as was well exemplified with the case of Silicon Valley Bank, people don't have to actually stand outside the branch waiting for it to open. They can go online, and with a few mouse clicks, their deposits can be moved from a bank that they perceive to be unsafe to a much safer bank. Rational and prudent actions by individual depositors to limit their risks may create financial contagion and thereby accelerate a run on the bank. The likelihood of contagion underlies the reason why many governments have deposit guarantee schemes. Not all governments do. The United States has the Federal Deposit Insurance Corporation. There are similar rules in effect in both the UK and the European Union. But for example, most of the banks within the Gulf countries, the GCC countries, do not have a particular deposit insurance scheme. And one other key idea that arises in this context is to contrast between the contractual nature of deposits, say term deposits versus demand deposits or sight deposits, but also the actual behavior of depositors. It may well be that a person has money on deposit at a bank which technically they could literally withdraw immediately, but from a behavioral perspective, that deposit might well be quite stable, or to use the jargon, it could be considered to be a sticky deposit. Now, there is a trade-off between also, now thinking about this from the bank's perspective, there is a trade-off between having deposits and the types of deposits and the amount that banks need to pay on those deposits versus pure sort of P&L issues. Banks with a strong, stable customer funding base have less need of short-term wholesale market funding. During market stress, a bank can derive greater comfort from having more sticky term deposits. But these are more expensive for banks. Banks typically pay out, say, a higher rate of return or interest on a one-year CD, certificate of deposit, than they would pay on their demand deposits. In some cases, and under certain economic conditions, they may pay no interest at all on demand deposits. But this idea of having a higher rate on, say, contractual term deposits may be de-emphasized in a bank's liability strategy. But it is prudent not to allow pure P&L objectives to dictate the structure of deposits. And this very much adheres to the focus within Basel III on more long-term stable funding, which is the ratio known as NSFR, Net Stable Funding Ratio. Let's have a look at what can happen when you do have a bank run. As just mentioned a moment ago, you can see there two images, both taken from this bank in the UK, Northern Rock Bank. Now, Northern Rock was not a major bank, but it had a significant presence. It was not necessarily a complex bank. It focused mainly on the retail market and also providing residential mortgages. Back in the late summer of 07, Northern Rock suffered a major bank run. And as you can see, these people were lined up outside these branches waiting for them to open so they can go in and withdraw their deposits. Now, at the time, this comment was made, this isn't about solvency, it is about a short-term problem that Northern Rock has in getting liquidity. That is, getting some cash from the normal interbank lending market. Now, that comment was made by the woman at the time who was heading up the British Bankers Association, and I'm sure that when she said it, that was her feeling as to what the problem was, but in fact the problem did not improve, despite the bank even going to obtain emergency liquidity assistance from the Bank of England, and eventually the bank did become insolvent and was eventually wound up, liquidated, although a part of it was in fact sold off. The lady in question, her name was Angela Knight. She was, as I say, the CEO at the time of the British Bankers Association. and that's going to be seen from this article in the FT, and you can see the date here, September 2007. The gentleman here was the Chancellor, the Finance Minister in the UK at the time, and he stepped in to halt the bank run, and in fact no depositors actually lost money, despite there being at that time a £50,000 limit on what was actually insured under the deposit insurance scheme. So I've mentioned the Northern Rock business model. It had rapid asset growth in pursuit of market share, which essentially was focused on residential real estate. It used securitization to support this accelerated asset growth, but thereby didn't have funding diversification. In August, September of 2007, problems developed in the interbank and asset-backed commercial paper market, problems in the London market, money market, and also in New York, where some of the securitizations were taking place. Rumors began to circulate that the bank had funding problems. Unable to roll its overnight funding, it went to the Bank of England for emergency liquidity assistance. But the media headlines at the time precipitated a run on the bank, which, as I said, ultimately led to their insolvency. Let's just touch briefly on the Lehman Brothers business model. The balance sheet was excessively leveraged at roughly 50 times, which ultimately meant that there was insufficient Tier 1 capital. They had poor quality assets, including substantial exposures to the high yield and emerging market debt securities. They had a large and troubled commercial real estate portfolio. There was no retail deposit base. Lehman was essentially an investment bank and had no retail customers. Their funding was not diversified. It relied almost exclusively on the interbank repo market, for example. And ultimately, the liquidity crisis became a solvency matter when it was realized that no one would continue to lend to it, and the US government was unwilling to rescue it. The Lehman Brothers story has been covered in some detail elsewhere. I just want to point to this rather remarkable excerpt from the very last 10Q filing. This is the filing that all public corporations must make in the United States. And as you can see, this one was filed at the end of February of 2008. And it shows the following, that this comes from the balance sheet. You can see that the bank had a total balance sheet size of around $400 billion. And the key line to look at is this one here, which shows securities sold under agreements to repurchase. In other words, this is the repo market, and this was effectively 100 billion. So what we're actually seeing is that when Bear Stearns, which would have collapsed, but was actually bought out on a bargain deal by JP Morgan, when this bank was on the verge of collapse, 1/4 of its funding came from the repo market. And many of these repos were essentially very short-term, often overnight borrowing. That is a completely unsustainable model and highlights some of the issues I've talked about, that there was no diversified funding. So in conclusion, let us see what kinds of lessons can be learned from the 2008 systemic liquidity crisis. The banking sector has often been accused of having a pro-cyclical bias, which is the idea that credit risk assessment and funding expectations are unduly perhaps optimistic. When times are good, the broad economic background is favorable, banks are profitable, there is a tendency to relax the underwriting standards and provide perhaps more credit than should be extended. Some of the new requirements under Basel III, introduced after the 2008 crisis, have addressed this issue of the pro-cyclicality, and there is in fact now a need for banks to carry what's known as a counter-cyclical capital buffer. There was an overconfidence that interbank liquidity would be plentiful. Many banks did not have adequate capital and liquidity buffers for their individual products and business lines during a period which eventually manifested itself of systemic market stress. A sense of complacency led to the view that severe and prolonged liquidity disruptions were improbable, and even should they arise, they would be only temporary. Regulators had overlooked the need for banks to put their balance sheets under stress to see what would happen, for example, when the repo markets became dysfunctional or when banks were having to liquidate their most liquid assets in order to meet margin calls and various other commitments. And much of this, of course, is now reflected in the regulations that came about under Basel III following the financial crisis. Well, I hope very much that you found that video to be of interest and valuable. And could I suggest that you subscribe to my channel, the Corcoran Codex, where the theme is analyzing critical ideas and episodes in the world of global finance. If you do subscribe, then you will be notified as to when I add new material to the channel, which I do on a regular basis. Thank you very much for watching. Well, I hope very much that you found that video to be of interest and valuable. And could I suggest that you subscribe to my channel, the Corcoran Codex, where the theme is analyzing critical ideas and episodes in the world of global finance. If you do subscribe, then you will be notified as to when I add new material to the channel, which I do on a regular basis. Thank you very much for watching.